Japan is the other market we're focused on, given the coordinated intervention between the U.S. and Japan. I mean, is that impacting Japanese stocks? How are you looking at Japanese stocks right now?
It is, for sure. We actually wrote a timely piece on this, lead authored by Bruce Kirk, who's our chief Japan strategist, and we compared explicitly the current setup in the Japan market, not just the equity market, but the broader macroeconomic and market environment, to what happened in July and August in 2024, 2 years ago. And the two key important points to note here are that, number one, at that point, non-commercial hedging, which is sort of the speculating aspect, which is available on Bloomberg, by the way, little shout out, but it's something you look at, and it's a great data point. So that was basically at record short contracts, like 180,000 short contracts, and that meant that the market was set up. Everyone was sort of long the carry trade, i.e. short Japan yen and long other higher yielding currencies, and that basically, when you had the intervention come in, you were kind of pushing on a vulnerable part of the market, and so you closed out the speculators, and you had that very strong upward move, sort of appreciation of the Japanese yen, and that in turn hurt the Japanese equity market. If you compare the current setup, you're actually back to pretty much the same record short amount in terms of yen. So it was a fertile situation for the intervention to take place. Now, we don't think fundamentally that the yen is as vulnerable to appreciating as it was 2 years ago because of growth differentials and interest rate differentials. So fundamentally, we don't think it should rally as much. However, the equity market is somewhat more vulnerable just because it's done so well and valuations are higher than they were 2 years ago. So our view was that we didn't think the yen would rally as much this time. We thought the equity market, which we're bullish on structurally, was at risk of some kind of tactical correction. And that still remains broadly our view. We've had this surprise intervention. It came at a vulnerable time, over the weekend, coordinated, U.S. came in, et cetera, as you've been describing on a previous segment. But we don't think fundamentally that the yen can appreciate as much because there is more pressure, as you said, in terms of the intersection between fiscal policy, what's priced in the bond market, what the BOJ has done, and we think that needs that circle needs to square somewhat.
So fundamentally, I mean, hearing what you have just said, fundamentally it means that the earnings for the corporates in Japan stays intact. If the yen is not expected to appreciate.
If the yen is not expected, absolutely. We actually just recently, two weeks ago, raised our TOPIX earnings for Japan by a couple of percent, really just baking in a weaker expected average exchange rate level. Because the simple metric for your viewers is that every 10-point move in the U.S. dollar Japanese yen exchange rate on a one-year average basis maps onto about a 4% change in earnings. So if the yen is weaker by 10 on average through the course of the year by 10 points in the U.S. dollar JPY exchange rate, that would map onto roughly about 4% earnings growth. So since the yen is weaker than we've been baking in at the beginning of the year, we then raised our numbers by about 2%.